The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Apologies to Thin Lizzy, but the Bulls are back in town. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
I had to think about that because I was thinking Chicago Bulls. What is he talking about? But I know. I'm Scarlet Food. Let's kick you off to the closing bell here in the U.S. And we are looking at stocks at session highs right now with the S&P 500 gaining 0.7%. This is the 8th straight day of gains, the longest rally since last November. As for small caps, you're seeing them outperform the S&P 500 once again. So we always come back to that question. Is that rotation into small caps intact for today? Yes, it is. Volatility remains subdued with the VIX below 15 yet again. Certainly a far cry from when it was at 65 just 2 weeks ago. And modest moves in treasuries with yields coming in slightly. The 10-year at 3.86% remain.
Yeah, but we go back to the top of the screen, 55.92 and change. The Bulls have definitely clearly regained control over the market narrative, drawing more and more money off the sidelines, with investors last week plowing $5.5 billion into U.S. equities. And at the global level, it's now been 17 straight weeks of investors pulling back into stock funds, buying $225 billion of shares in what, remember, is typically a weak period of seasonality. But there is a big kink in the road with Fed Chair Jay Powell's speech on Friday at the Jackson Hole Symposium, typically a symposium that isn't a big catalyst for the stock market unless it comes before a crucial shift in monetary policy. And that's where we are today, a market pricing in a crucial shift of 90 basis points of rate cuts later this year, and as much as 150 basis points for 2025.
For the market to price 250 basis points of easing by the Fed next 12 months, I think that's far-fetched. So we do think the big rally's done. I think we'll get zero out of Jay Powell on Friday. I think it's probably a good time to take a nap for most people.
Well, investors aren't quite ready to say night-night to this rally, particularly amid an uptick in M&A activity that reflects rising confidence among corporations in the state of financial markets. 7-Eleven is the latest mega deal out there, soaring 20% on a takeover proposal from the owner of Circle K. That's part of more than $725 billion of deals announced since May, including that $36 billion mashup of Mars Inc. and Kellanova, as well as Boeing's $4.7 billion purchase, Scarlett, of Spirit AeroSystems.
Absolutely. There's a lot of activity on that but it all really boils down to what the Federal Reserve does next. And that is something that traders have been pricing and repricing all this month. Take a look at the blue line. It's the 2-year yield, which is, of course, ultra sensitive to Fed policy. The white line is S&P 500 futures. The bottom panel, by the way, shows the correlation between the two lines. Look here at how both lines plunged at the start of August when the monthly jobs data showed a weaker than expected labor economy. But in the days after, as reports on inflation, jobless claims, and retail sales came in better than feared, both stocks and the 2-year yield recovered. Obviously, the 2-year yield a lot less than futures. But it is a sign that good economic news is being interpreted as good news for risk assets. Romaine?
And it will be interesting to see what that market reaction is on Friday, both in the equity markets and the bond markets to boot, with the 2-year yield back above that 4% level, the 10-year still firmly camped out, down around 3.9. Tony Crescenzi joining us right now, portfolio manager and market strategist over at Pimco, joining us here in New York in Studio 2. Great to see you, Tony.
Great to see you.
Let's talk about yields and where they go next. I assume they're going down because right now the market assumes the Fed is going to cut down that Fed funds rate at least 2 or 3 times this year.
Yeah, it's become a trending market rather than a range-bound market. Yeah. You see yields continuing to fall, and it's probably to the surprise of some, because many think that the inflation rate's still high. Many think that yields have fallen enough, but in a trending market, and with the Fed embarking on interest rate cuts, a regime most likely, it's still early innings to be a fixed income investor. It's still early innings in the sense that there'll probably be good returns for the next couple of years. So we would suggest that investors be in a buy mode for bonds for the next 1 to 2 years, simply because that tends to be the trend in terms of how performance goes.
When you say a buy mode, are you talking maybe longer duration bonds, the idea of you're locking in interest rates, or something more shorter term where you're taking advantage of the price action?
It's a nuanced opinion, view. We would say extend your duration, meaning out to the intermediate part of the curve, called the 5, 6, 7 year part of the yield curve. In fact, I'd like to call the 5-year the long bond of the short end. It tends to react pretty well to changes in short-term interest rates. That said, that's an extension from T-bills, let's say. Many are parked in deposit accounts with very low duration. But when we think of duration firm-wide at Pimco, we're thinking to be more tactical now because yields have fallen pretty fast, so more cautious about the very short end of the yield curve, where there's a lot of pricing for interest rate cuts. So that's a view when thinking about indexes, like the Bloomberg aggregate, which has a 6-year maturity or duration. We want to be somewhat neutral to that, even the slightest bit underweight simply tactically, but that's much longer, the 6 years, than T-bills.
So Romain talked about this, and you just mentioned it as well, all that pricing in of rate cuts. If you pull up a chart, you look at how there's a Fed cut priced in for every meeting for the next 5 meetings, which is pretty remarkable given that the Federal Reserve has not even embarked on the first rate cut yet. What are you thinking in terms of how much investors or traders will be caught offsides here?
Well, it has us thinking back to the start of the year when the bond market thought that there would be about 150 basis points in rate cuts, and this certainly will not be, but we may get closer to that. And investors shouldn't really concern themselves all that much about the one meeting or the next, and think about the end game. And the end game for the bond market is a pricing for a 3% policy rate. That seems pretty reasonable, and that's for the rest of the decade. So imagine in a case where there's a recession, the Fed itself, in its quarterly summary of economic projections, says that the neutral policy rate is 2.8. So what if there's a recession? Typically, in a recession, the Fed brings the policy rate below the neutral rate. So it's quite possible somewhere in the future, somewhere the rest of the decade, based on those data, that the figure's in the 2s. And so therefore, there's room to run. And so that gets you out of thinking about the next meeting and the meeting after that as an investor and thinking about locking in today's yields. Bloomberg aggregate at 4.5%, with inflation probably headed into the low 2s. It's already at 2.5-ish based on the Fed's favorite gauge. And that's pretty attractive relative to that. And so it's time to lock it in and think total return.
There's one thing that you point out, which is that people are a little bit too fixated on the Fed's 2% objective. That's kind of not arbitrary, but it doesn't really capture the spirit of what the Fed is trying to achieve.
Right. I'm glad you point that out, Scott. It's one of my favorite topics because, you know, I've been in the business for a long time, since the 80s, and the Greenspan era, the Volcker era, and, of course, Ben Bernanke and Janet Yellen. Before 2012, we didn't have a number. We didn't have a 2% figure to guide us as investors in the stock market, the bond market, or even in real estate. We had this notion of price stability, which Alan Greenspan, the former Fed chair, and Paul Volcker, the legendary Fed chair before him, defined as a level of price changes that ceases to have impact on household and business decision-making. That seems to be the case. The economy is performing well. And the data all show, there's a final point, that when the inflation rate's somewhere in the 2s, call it 2 point something, just simply stable, that the correlation between bonds and stocks is pretty normal relative to history, which is to say, when stock prices fall, bond prices will rise. And so the correlation, you can depend on it when the inflation rate's stable. And that's the key thing to be thinking about, not the 2% figure, because that'll keep you from buying bonds and stocks and doing other things in markets.
But it raises a lot of questions as to whether we need to even get rid of that 2% figure altogether. I mean, there are some people who say we should never have adopted it to begin with. But the idea is that we're talking about a marker in the sand that even the Fed now has said should be a little bit more squishy than what it used to be.
Well, it probably won't get rid of it because it's an anchor, and plus it's been socialized as a figure. It probably won't raise the number because that'll set off alarms that the Fed might tolerate inflation rate near 3%, which it clearly won't. So it'll probably be happy that the inflation rate's stable, the Fed, if in fact that's what happens, and that's the end game. But it still will persist until it reaches the 2% objective.
Yeah, you kind of wonder, like, what happened before we had that 2% target? We were all just going
there.
fatter.
You simply had to go on the notion, are prices stable or not? Is it a threat to me? An investor, a household, or a business?
All right, Tony, going to have to leave it there. Always great to talk to you.
Thanks so much.
Tony Crescenzi, portfolio manager and market strategist over at Pimco, kicking us off to the close here on this Monday afternoon with a big focus today on what could be the biggest foreign takeover of a Japanese company, the owner of Circle K, kicking the tires of the owner of 7 11/11, a conversation coming up in just a second.
And if that's not enough M&A for you, chip maker AMD announcing plans to acquire the server maker ZT Systems, setting its sight on closing the gap with runaway leader NVIDIA. We're going to have Bob Profusek, the global chair of M&A at Jones Day, giving us the landscape for M&A.
But before we get to there, we're going to go out to Chicago, the Democratic National Convention kicking off, expecting to hear from Vice President Kamala Harris, and of course tonight, what a lot of people say is a big exit speech by President Joe Biden. All that and more coming up in just a bit. This is The Close on Bloomberg.
This week, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for continuing coverage leading up to a special episode of Surveillance August 23rd at 9 a.m.
The Democratic National Convention kicking off today in the Windy City with President Joe Biden expected to address the crowd later this evening, the final step in passing the candidacy baton to Vice President Kamala Harris. Bloomberg's Joe Mathieu is in the thick of the action live in Chicago. Joe, before President Biden speaks, what happens? Are there kind of administrative things that get taken care of in the lead up to that?
Yeah, there's a little bit of business to be had. It's not too challenging here. They'll have a vote to adopt the party platform, which is typically how things begin, sort of a statement of values, and that won't be controversial. And then the actual nominating roll call takes place for the president and the running mate here. In this case, though, it was done virtually, as we discussed. So that's kind of a foregone conclusion. They'll go through the motions here today, get everybody in the room. The delegates will have a little bit of time to mingle, and then we get onto the speeches in prime time. And of course, tonight is all about President Biden, and we're kind of curious to see what the tone's going to be, Romaine, because reports say he's not very happy about all this.
Well, I am curious. Okay, well, I kind of mood at this point, I guess, but I am curious, Joe. I mean, let's talk about those primetime speeches, because, I mean, a lot of what goes on behind the scenes, of course, is more in service of the Democratic Party itself. These speeches, of course, are designed to appeal to more than just the Democratic faithful here. What do you expect Biden and some of the other speakers to say tonight? Are they going to try to appeal to the broader masses?
Well, they're going to have to. I mean, obviously, both campaigns, to your point, Romaine, are fighting over a very thin slice of pie here. And when you look at the most recent polling we saw from the Washington Post, ABC News, Ipsos over the weekend, Kamala Harris is leading by 8 points when it comes to independent voters, and they are going to be a very big part of the audience tonight. But it's kind of a balancing act. You've got to talk to the Democratic delegates, the faithful there in the room who want to hear about progressive values and applaud the candidate, but also some people in their living rooms who could use some convincing. Tonight, though, it's going to be a little bit less about Kamala Harris and a lot more about Joe Biden. And we're going to be hearing from the First Lady. Jill Biden will speak. Hillary Clinton is also going to be speaking tonight. So it's kind of starting with the old, ending with the new this week on Thursday night with Kamala Harris.
I was about to say, definitely starting with the old there.
Joe, I got to ask you about what's going on when it comes to protests, because we know that the Democrats are a party that's united. Yep. They've really united around the new candidate, Kamala Harris. But, of course, there is that perpetual issue of the pro-Palestinian protesters and how they plan to disrupt this convention.
Well, at least attempt to make a point. I don't know how much of the convention will be disrupted. I will tell you there are 30 roughly uncommitted delegates who are pro-Palestinian activists who are going to be on the floor of the convention. We'll see if that results in any kind of disruption. But outside is a very different story. Tens of thousands of protesters are in Chicago for this event. The big marches are set to begin a little bit later on today. We haven't seen massive congregations of protesters, but they were marching down Michigan Avenue last evening pretty late, blocking some roads and some hotel entrances. We'll see how the police handle this, though, because they're trying to be very careful to not duplicate images from 1968. We're also, hearing a lot of comparisons to the 1968 convention. They don't want to see images of, billy clubs and pepper spray. So to the extent that the protests stay peaceful might be a really good story for the Democrats to be able to tell.
Yeah, Joe, just do yourself a favor. Get outside the security perimeter. Go just take in the real Chicago. If you need some restaurant recommendations that are far removed from all those protesters, just hit me up. I'll let you know. Joe Mathieu, of course.
I'm waiting to hear from you. I want you to know we had a great night at Kingston Mines, Romain. We were thinking of you.
Wow, you guys are out there partying. I didn't even know Kingston Mines was still around. That takes me back to my childhood. Joe, we got to leave it there. Joe, Mathieu, Kaylee Lines on the ground at the DNC in Chicago. Of course, we'll catch up with them every day of the convention here. There's going to be a lot of focus, not just sort of on the spectacle of this, but also kind of like what is the pitch to the American people beyond just the Democratic faithful.
Yeah, well, I mean, part of it is we got a sneak preview of that from Kamala Harris's speech on her economic plan. Yeah. It's kind of broad, it's kind of general, but continue to ride the good wave of goodwill that everyone's given her so far.
Yeah, and of course, there's always sort of this little post-convention bump that all the candidates get. We saw that with Trump. Maybe Kamala will get that coming out of the DNC. But then, of course, the real work comes, and that's really the next 70-something days until the November election.
Where should they go for Italian beef sandwiches?
Oh, my gosh, don't start, Scarlett. Scarlett Fu, big fan of the bear there. Stick with us here. We're going to have a lot of great references all week long. But before we get there, we have to talk about brass tacks and AMD taking a big step in the race to AI chip and hardware dominance with a $5 billion acquisition. We're going to get a bird's eye view from Stacy Rasgon, senior chip analyst over at Bernstein. Stick with us. This is Bloomberg. Let's get a view from the sell side. Top calls, a look at some of the big movers on the back of analyst recommendations. And we start off today with Shake Shack. Piper Sandler asking, where's the beef? Downgrading the burger chain to neutral as they temper their view on restaurant traffic and promotional trends in the fast casual sector. The analyst says he's not negative on Shake Shack, but sees the current risk-reward as more balanced. The firm also downgrading Dutch Bros and Sweet Green shares of Shake Shack down 3% on the day. Next in line, Taylor Morrison Home, upgraded to buy over at BTIG with the analyst encouraged by the home builder's valuation and growth potential that is giving him increased confidence in the roadmap for long-term structural goals. The analyst adding that with almost 7 years of land supply, Taylor Morrison will soon see the fruits of its labor ramp up. Those shares getting the bid about 3% higher on the day. And finally, HPE Inc. Morgan Stanley hitting the backspace key with the downgrade to equal weight. The firm says the market has already priced in the return to revenue growth for the personal computer segment, the stabilization of print margins, and the acceleration of capital returns. Nevertheless, well, you see the downdraft here in the shares down about 3.4%, and those are some of our top calls. We do want to flip to a big gainer on the day, and that is AMD, up about 4% here on the day after agreeing to buy AI infrastructure group ZT Systems, a $4.9 billion cash and stock transaction. And what is apparently a challenge to market leader NVIDIA. Stacy Rasgon, one of the best in the business, joining us right now. He's senior analyst covering U.S. semiconductors at Bernstein Research. And let's start off with the structure of this deal. This is basically data centers, which last time I checked appears to be the hottest game in town. What is AMD going for here?
Yeah, you bet. So this is actually, the structure is a little different than, it's actually almost like an acqui-hire. So ZT Systems has two pieces of it. They've got a server manufacturing business, and then they've got like a services and support business with effectively like 100 systems design engineers. That's the piece that AMD wants. They're actually going to sell the manufacturing piece post-close. They're going to list it as discontinued operations and then find a strategic partner to sell it. So the $4.9 billion value of this, it'll be like less than that, less whatever they can get for that business. But they don't want that piece. It's low margin and it puts them in direct competition with their customers. What they want is the systems expertise. If you look at the things that they're selling, these enormous AI clusters are getting more and more complex. And their large customers, especially their large hyperscale customers, they don't really buy single GPUs. They buy systems, and they interlock like tons and tons of these things together. And so you really need that systems expertise that their larger competitor has in spades. I almost view this, it's kind of a confession on AMD's part that they do not have what they need. Yeah. Given the demands of their large customers, they need to get it, and so this is how they are doing it. So in some sense, it's a confession on that. But I mean, better to do it if you need it than not do it.
Well, that's what I'm curious about, Stacy, like where they kind of stand and sort of this all AI hype. And we've obviously broadened that out because I know it's just bigger than just AI itself. But where do they stand in that? Because all the focus right now is on Jensen Huang and what he's doing over at NVIDIA. Yeah. Where is AMD's place in this?
Yeah, so I mean, they're a second source, but they're small. And again, I don't want to knock AMD too hard. So they said that they would do $4.5 billion of AI sales this year. And for some comparison, I mean, their larger competitor probably do $100 billion worth this year. So they'll do 4.5, 5, whatever. And it was zero a year ago. So even ramping up, objectively, that's a very good performance. I mean, relative to what's going on in the market, it's very, very small. But I mean, objectively, it was zero. It's good. However, it's not enough to just have a good chip. And I think they've got a decent chip. I don't know that it's as good as the other, but they've got a decent chip. And it's the chip, and it's the software ecosystem and the networking and the hardware and the systems and everything. So they've been assembling all of those, trying to assemble all those pieces. They have the chip internally. They bought a networking company a couple of years ago called Pensando. They've been doing a lot of work on the software side. They bought some AI software companies recently, and now they've got this to try to get the systems expertise that they need. So they're trying to assemble the building blocks to be able to offer the whole ecosystem that their competitor has delivered already in large amount.
You just mentioned that they're going to sell off the manufacturing part of the business to someone else, but in doing so, it'll still keep about 1,000 engineers. So how much of this is a play for talent, where AMD is stocking up on talent? Yeah?
All of it. This, like I said, this is an acqui-hire is my interpretation of it. They're paying, again, headline numbers, a little under $5 billion. Once they sell it, maybe it's a few billion they're paying for the privilege of bringing over 1,000, system design engineers. And it's going to be $150 million in incremental OpEx and very little revenue right now. The revenue synergies, such as they are, and they were very honest about it, it's the hope that they will be able to sell more GPUs going forward. They have this expertise in-house.
Does this put any pressure on NVIDIA to make any kind of acquisition to keep its lead, maintain its lead?
I don't think so. No, I mean, look, NVIDIA's already got everything they need on these. They developed it in-house over many, many years. So no, I think this is others trying to close the gaps and fill the expertise holes and the functional holes that they didn't have. That's they're trying to do. But even there, NVIDIA's fully integrated, and like I said, they developed this. It's like a well-oiled machine. At least it looks like that from the side. AMD's going to have to assemble this together from the various parts that they've been acquiring.
Yeah, well, that's what it's like when you're trying to play catch-up. Stacy, really appreciate it. Stacy Rasgon of Bernstein Research, very enthusiastic Stacy Rasgon. And this idea that NVIDIA kind of sets the tone and everyone else has to play catch up here. NVIDIA, of course, reports earnings next Wednesday. And I've been tracking to see whether analysts have been adjusting any of their estimates for the full year. No real movement. It's been pretty static, even with a rethink or a reassessment of what companies are delivering in terms of the AI investments they've made.
Yeah, I mean, it gets to the idea. I mean, obviously you had a lot of sort of experimentation in terms of people who were buying these chips. And I think that's where you're seeing the drop off, but there are other folks still committed to it. And of course, NVIDIA really has the best thing going for it right now is that it is effectively a monopoly. If you want that specific type of powered chip, you basically have two options, and they are the primary option.
Yeah, that and first mover advantage, which in this case, the only mover advantage, right?
Yeah, absolutely.
So there you go. All right, coming up, we've got a lot more to discuss because we talked about AMD buying this company. The M&A market is sparking to life over the last week. It's not just AMD, it goes beyond that. What two major deals announced this morning mean for the markets overall? This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Scarlett Fu. I just keep thinking back to what it was like 2 weeks ago when, remember 2 weeks ago, August 5th, when the market, the VIX surged to 65 and people were in a panic. Yeah.
Okay, I think I was off that day. But if you were asleep for the last 2 weeks, you probably wouldn't even have known anything happened.
Yeah, because the VIX is now back below 15. Everything's calm again.
Yeah.
People are moving forward.
And you got an 8-day run here in the markets. Everyone's pricing in now more rate cuts. And I don't know if that's a direct correlation to some of the uptick that we've seen in M&A activity.
I don't know. It's a good question. I mean, there's a lot of M&A headlines, including what would be the biggest foreign takeover of a Japanese company. Canada-based Circle K operator Couche-Tard has made a proposal to take over its much larger rival 7-Eleven owner 7&I Holdings. Bloomberg's Crystal C joins us now to break down the deal. Crystal, what do we need to know about this deal?
So what we know so far is that Kestra has made a friendly, non-binding proposal to buy Seven & I. The really interesting thing here is that this is going to be, like you said, the biggest takeover of a Japanese company. And so far, we don't have details on price, but we can probably speculate, like you said, the interest rate expectation that it's going to be lower, as well as the lower yen, is also helping this particular transaction.
Any sense here, Crystal, that there would be any major regulatory or government hurdles to getting this done?
I think in this day and age, if you were to do any sort of kind of consolidation transaction, you will have to take into account that there will be antitrust concerns. And in this case, this is such a global operation. You're probably inviting regulatory scrutiny from many different geography. So if you remember, actually, Seven & I has a big presence in the U.S. with its Speedway purchases. They own thousands of stores in the U.S. and combining the Speedway brand as well as the 7-Eleven brand. So U.S. is going to be a big player in this transaction, as well as whether the Japanese government is going to sign off on a foreign buyer. So between CFIUS and antitrust, there are many, many regulatory hurdles to jump through.
All right, a multi-billion-dollar deal potentially. Crystal C, of course, covering this story for us. And the announcement today adds to the spate of M&A activity we've seen. More than $725 billion worth of deals announced since the end of May. That's 20% higher than the same stretch that we had in 2023. Bob Profusek joining us right now, global chair of M&A at Jones Day. Basically, one of the first calls you make if you're planning a deal here. And we've seen a significant uptick in activity, and not like little piddling deals either. I mean, you had the Mars thing announced last week, the whole Boeing Spirit Aero system. There's a meaningful uptick in activity right now.
Yes, there's the last 6 weeks have been really extraordinary in terms of just the number of things that people are looking at. It's in, everybody says, well, why is this? Well, it's hard to pin it on one thing. There's a lot of factors that combine. I actually think one of the biggest things is the election. Not so much who's going to win. Guessing that is a fool's errand, I think. But there will be a change no matter who wins. And, of course, this administration, the current administration, has been very aggressive. So the thought is there'll be a period of quiescence, probably not, but confusion, probably. And maybe you can get things through that might be harder to do later.
Well, on the regulatory issue, because that seemed to have been at least maybe a contributor to some of the lull we saw. I know interest rates and economic conditions also were a huge factor. But let's just stay on the regulatory side here. Is there a sense here that even if we do end up with a Harris administration, which is basically going to be Biden 2.0, is there any sense here that maybe it's kind of run its course, some of these regulatory actions? Because so far they haven't been very successful in blocking a lot of deals.
No, but they've sure tried a lot. They haven't been successful. But, when you think about it, in the last 2 years, there's been almost 100 cases filed against mergers. Wow. That's a lot. These aren't, it's not like people wake up one day and say, oh, let's do a merger, make an announcement. There's a lot of analysis that goes into it. Lots and lots of very sophisticated lawyers and economists and others that weigh in. They say this should be doable, because you don't announce something if you don't think you're going to be able to do it, especially if you're a target. And so, that's an extraordinary number. Part of it is there are some theories that have been advanced, particularly on the FTC side, that are unusual to be charitable. They're very, very aggressive. So it's hardly imaginable that it gets worse, is the answer. And a period of confusion, last quarter, first quarter next year, or that's probably a good time to be doing stuff.
And of course, it's not just that the FTC or the government hasn't had a great success rate. It's been a deterrent for anyone to even go forward and announce any kind of deal. I'm wondering how much currencies, particularly cheap currencies like the yen, might play into this pickup, especially with Kestra looking to buy 7 & I holdings.
That's always a factor. Fundamentally, we can talk about regulatory things. I'm a lawyer, so I like to do stuff like that, but it's about economics. And of course that plays a role. Just the idea that interest rates are not going up plays a big role. There's just no question about it. The currency thing is significant. I don't want to make a prediction about Kestra, but it's a pretty extraordinary thing. This is a Japanese company. Now, Japan, which has gotten a lot of criticism over the years for being Fortress Japan when it comes to these things, recently actually made their rules more liberal about foreign takeovers. Will that matter? This is just a proposal. It's not a deal that's been made. On the other hand, Kestra has been a very acquisitive company. It's not that well known, but they bought CST, that was the Valero stations. They've bought a lot of things over the years. It's a big, sophisticated company.
And a lot of cross-border transactions,
too.
Yeah, so globalization is still very much a theme, even if as an investment theme, it becomes something that's a little bit more difficult to execute on. I also want to ask about technology, because AI is at the heart of why AMD is making this acquisition of this privately held company to catch up with NVIDIA, which is a little bit of a fool's errand as well.
Right. Well, technology in a broader sense is the engine for all of this. When you think about it, it's what changes everything. It's what makes companies think they have to, zig when other people are zagging. It really changes everything. AI, how revolutionary it is, I don't know, but it's certainly going to change things. And people do have to catch up. And the fact that, a firm like AMD, which is a darn good, firm, would think that it needs to do something like this just shows how important it is. But it even spills over to, the government's arguing in a big grocery store merger right now that people just walk to the grocery store and park their car and walk in. That's the market anymore. It's not the market for groceries. The market for groceries is on your screen. It's everywhere. It changes everything. So that's why, no matter what the government does, people are going to be compelled to make moves that move their businesses forward. There's just no question about it.
Bob, always a pleasure to have you with us. Bob Profusek is Global Chair of M&A at Jones Day, talking about the recent pickup we've seen in M&A activity.
All right, coming up in just a second here, we're going to take a closer look at some of the economic weakness across the globe, particularly in China, and how, well, it cost one CEO his job. Estee Lauder is our stock of the hour, and it's coming up next. This is The Close on Bloomberg.
We're looking at shares of Estee Lauder now modestly lower after bouncing around in the pre-market trade this morning as the global cosmetics giant reported earnings. The big headline, though, is that the CEO, Fabrizio Freda, announced plans to retire at the end of June 2025. So we brought in Abigail Doolittle to give us a little more context here. The stock initially plunged, then it bounced right back hard, and now it's kind of just drifting lower.
I think that a lot of the plunge had to do with the guidance. The bouncing back higher and the drifting have to do with the fact that they're going to get a new management. But the funny thing is, Fabrizio Freda, the current CEO, he won't be stepping down until June of next year. So there's quite a bit of time between now and then. But the real deal here is, in terms of why investors are a little bit worried, a little bit anxious, is the stock's down 35% from the 2022 peak. And over that time period, numbers have really gone in the wrong way. Specifically for the fiscal year that just was, that ended in June, sales down about 2%. In 2022, they had been up nearly 10%. On the bottom line, down 24% after being down 52% in 2023, after being up 14% in 2022. So again, just going in the wrong direction. They have this plan called Profit Recovery and Growth. It apparently is not going to be very straightforward. Some of the pros, they're very flexible, the strategy. And something I would point out, they have good product, but as we've been talking about relative to Neutrogena and relative to ELF, there's so many skincare products out there at this point. I think that they've gotten a little bit lost in that shuffle.
They've gotten lost in that shuffle, but there were also a lot of geographic decisions that they made that seem to be biting them now.
Yes.
And I do wonder, though, I mean, I know he's been there for a while, so maybe it was just time for a change. I think he'd been there like a decade, at least as CEO. But it gets to this question, though, as to if you are going to bet on China, do you really believe that China is just in some sort of temporary lull and that consumer spending will come back?
That's a great question, Romaine, because I believe, and I'm going to check right now, but into this year, the Chinese stock market and the U.S. stock market had been at odds. Chinese stocks down 4 or 5 years as a way of looking at that economy. They really never have had that bounce back out of the pandemic that we've been looking for, really. So, it's hard to really say whether or not. I think that because of the population there, businesses want to make that bet, but there's just not enough information.
But it brings up the issue, too, of whether they need to be more diversified as well. And I don't know what the new strategy is going to be or how much the current CEO is going to be in charge of that. I know he's still got probably almost a year before he actually departs here. But at some point, they've got to think longer term as to where they fit in.
It's interesting. If you take a look at their segmentation, they are actually pretty well diversified. They have 30% in Asia, 30% roughly in North America, and then 30% in, sort of the rest of the world. But I think it's that China weakness and also the idea that this is a luxury skincare product and that it's not being bought up in the same way. I think that that's some of the pain. So in terms of repositioning themselves, I guess they've really got their work cut out for themselves, or to hope that China's going to come back to some degree.
I feel like they should be taking on Alex Steele's mantra, which is invest in your face.
Invest in your face.
Part of their advertising campaign. But when it comes to Asia, talk a little bit about the implosion in sales at tax-free stores, because that's a big part of it. It's not just the Chinese consumer is reluctant to spend right now, but it's Chinese consumers aren't traveling, and a lot of the times they buy their products at the duty-free store.
Well, it's interesting. I saw something on social media weeks ago about the idea of like whoever bought things at the duty-free stores, but apparently it has really been a trend, and because of the lack of traveling, that yes, that is a piece of the story, that those stores are not selling the kind of product they used to be. Although I was at an airport not so long ago, and it looked pretty busy to me, although not in China. So maybe that's a piece of it. But yes, that's the overall lack of recovery in the China consumer right now. And also just the lack of visibility. It's an issue.
All right, well done. Abigail Doolittle with the latest on Estee Lauder. June 2025, that's a long time to like tell everyone that the CEO is leaving and, we're going to put into place a succession plan. We just don't have any more details to give you at the moment. Yeah, well, that's because they didn't have a succession plan. Anyway, back in the here and now, we talk about a market that continues to climb higher here. Right now, looking at session highs or near session highs, I think, for most of the major indices here. And it raises the question here as to what interrupts this, if anything at all. I mean, obviously, the data didn't rattle people last week. The Fed speak didn't rattle people, nor did some of the lackluster earnings. Yeah, volume is very, very low, though. Let's keep in mind it's 31% below the 20-day average for the S&P 500. Kara Murphy, Chief Investment Officer, up next over at Kestra. This is Bloomberg.
In a trending market, and with the Fed embarking on interest rate cuts, a regime most likely, it's still early innings to be a fixed income investor. It's still early innings in the sense that there'll probably be good returns for the next couple of years.
Tony Crescenzi there, portfolio manager and market strategist over at Pimco, kicking us off to the close just about 50 minutes ago, with stocks right now at session highs, and S&P up 0.7%, and the NASDAQ now up about 1%.
And, I was looking at the advance, and it's really, really broad-based. You have 11 industry groups. They're all up in the green. And even when you break it down into 24 industry groups, it's pretty remarkable. Only one group, tech hardware, is in the red. Everything else is green. So despite the fact that we're looking at gains of 0.75% on its own, not very large, it's very, very well-rounded. Yeah, definitely much more than tech, at least here for this day. But a lot of questions here about the sustainability of the broadening of this rally, whether that is the narrative going forward. Let's pose that question to our next guest. Kara Murphy is the Chief Investment Officer over at Kestra Investment Management, joining us right now to count us down to those closing bells just about 9 minutes to go. And Kara, I am curious about the broadening of this rally. That kind of broke down over this last, 7 or 8 sessions, where we have seen some modest underperformance by the Russell, some modest underperformance by the S&P 500 equal weight index. But I am wondering if we see a resumption here of people looking to buy more than just those big tech stocks, those big sort of tried and true names.
I think this is going to be a theme for some time to come. And we first started talking about this a little while back and cautioned people that this type of a big shift in the market is never a straight line. So not surprising that we saw a bit of a pullback there from the Russell 2000. And we think as the Fed gets more into a rate cutting cycle, that this is likely to continue. And part of the reason why we think this is going to be a theme for a long time to come is simply because the outperformance of a handful of names has been so enormous and so dramatic for a pretty extended period of time that there's an awful lot of catch up for smaller names to have. There's also a huge valuation differential. Some of these smaller names are going to start to see earnings begin to come up again in later part of this year. So there are a lot of reasons for, I think, this to continue. With regards to the correlation with interest rates and what that means for some of these small cap stocks here, does that drop in interest rates, and we should just point out we're kind of anticipating something that the Fed refuses to confirm, but let's say we do get it,
I know that helps the balance sheet. Is that going to help the bottom line income statement immediately?
So I think it's a great question. And the answer is no. It's going to take a little while for that to filter in. And so far, our best guess is that the Fed does begin cutting interest rates in September, but is going to take a very measured approach, right? We're not going to see these massive declines in interest rates in the very near term. But as we all know, the market discounts forward about 12 months. And so they're going to begin to be looking at some of that earnings power that we think will start to come back online next year. And then let's not forget as well that huge valuation differential allows markets to look out even further. If you don't have to pay a lot for those earnings today, you can be a little bit more, less time sensitive about when those earnings come back.
We were talking about the macro, we're talking about the earnings fundamentals, but also there's a pickup in M&A, which we've been discussing, 2 big deals announced today. How does that build or add to sentiment right now in the market? I mean, it was not so long ago that we had this big growth scare, but it seems like that's very much in the rearview mirror, and people are talking as if animal spirits are back in full swing.
So this is one of those things that becomes a self-reinforcing cycle. As folks are more confident in the economic outlook, as interest rates start to come down, you start to see M&A picking up. As M&A picks up, then those smaller names tend to have better prospects as they're likely, acquisition candidates. And so that then becomes that self-reinforcing cycle. So I think, it's potentially animal spirits coming back. It's, firmer outlook from the economy, and then also cheaper funding that can help fuel those deals.
So how do you want to be positioned right now, Kara? For so long, we're also dependent on being overweight in big cap growth, namely tech. But is that still the right play going forward?
And so this becomes very tricky when you're looking at a whole portfolio, partly because if you are benchmarked to a core benchmark, that core benchmark is actually leaning very heavily growth and very heavily large cap. So you want to make sure, re-examine that portfolio, make sure that you have exposure to those mid and small caps, because chances are that you are leaning way heavier into those large cap names than what you thought you were. So it's an opportunity to start to bring that portfolio a little bit back towards center.
Talk a little bit about what that means, though, when we talk about back towards center, because there have been a lot of folks talking about this equilibrium here. And I'm just curious as to, for those folks who maybe don't understand the nuance of that, what exactly does that end up looking like?
Yeah, it's a really great question because it's hard to really understand. But if we look at, say, the S&P 500 and we compare value characteristics with growth characteristics, what's happened is that those growth names have so outperformed that they make up a much larger proportion of the overall benchmark. So if you simply, own those same names, those growth factors are so much bigger in your portfolio. So you can't simply rely on, let's say, the Russell 1000 or the S&P 500 to define core for you. You need to go find that elsewhere.
What type of sort of responses are you hearing from your clients and from other sort of folks in your peer group here? Are they really optimistic right now about where things are, or is everyone just kind of resigned to the fact that you don't fight the market, you don't fight the Fed, just ride it out?
I think people are feeling pretty optimistic right now. I mean, gosh, the broad equity market have done fantastically well, and we're heading into a period where the Fed's going to begin to cut interest rates. What's interesting is that I think some of this Fed rate cutting cycle then is going to provide some impetus to bring cash back into the market from money market funds. Now, not all of those dollars are going to go directly into the markets, but we could also start to see people push out in duration into other areas of fixed income as well. So I think what we're seeing is that money will be a little bit more on the move over the next 6 months or so.
I look at the VIX and it's back below 15, which is even lower than before that sell-off in late July that really crested on August 5th. Yet you look at the MOVE index, which tracks volatility in treasuries, and it's a lot higher. It's a lot more elevated. It has not gone back down to where it was before late July. What does that tell you, Kara, about where people's mindset is when it comes to investing in stocks versus bonds?
I think there's a really interesting story to look at volatility in the equity markets versus fixed income markets. So on the VIX side, VIX going back down to 15 tells me there's a little bit of complacency in the market, which is why we're sort of keeping an eye out for increased volatility. But interestingly, on the fixed income side, if you look at other measures of volatility in those markets, we've been at really, really high levels of volatility for about 2 years now. And investors feel that, right? And for a long time, that volatility meant underperformance. Yeah. Now that the Fed is likely to start cutting interest rates, that volatility might mean upward performance. But I think those levels remain very high and will likely start to subside.
All right, volatility tamped down just a little bit today. Expectations it could pick up as we get closer to the election. Kara, gonna have to leave it there. Chief Investment Officer over at Kestra Investment Management. With just about 2 minutes until we get to the closing bell, stocks continuing to add to their gains right now. The Nasdaq now up about 1.3% here. Still seeing a little bit of a mixed activity in the yield space here, and the dollar having an awful day. Stick with us. Full market coverage continuing right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here alongside Scarlett Fu. Alex Steele still, I think, paddling her way down the Taconic State Parkway somewhere. But our global simulcast must go on here. Carol Massar out as well. Tim Stenovic is here. Emily Grafeo stepping in for Carol. Welcome to our audiences across all of our Bloomberg platforms, radio, television, and our partnership with YouTube, Tim.
Yeah, day of a lot of green up there. The S&P 500 up right now for an 8th day in a row. Stocks are close to their best levels of the day. It's kind of the best winning streak, not even kind of, it is the best winning streak for the S&P 500 so far this year, Emily, a far cry from 2 weeks ago.
Exactly, and you're seeing those volatility markets drop. The VIX now down almost 2% today, like you said, a far cry from just 2 weeks ago where the S&P was down 3% on a day.
Yeah, but this is an August Monday. There's not a whole lot of volume. In the S&P 500, for instance, volume is down about 30% from the 20-day average. And aside from Jay Powell on Friday, there's a lot of people just kind of waiting, marking time until they hear from Powell.
Well, you're still seeing a lot of activity in the space here. Of course, there's a lot of people who stay invested in what are they bidding up, a lot of biotech, a lot of financial stocks, and, well, quite frankly, a lot of everything. I mean, it was something like 400 plus stocks in the S&P 500. We're getting bids today, Tim.
Yeah, I feel bad for anyone who has to do decliners today. That's why I ended up taking the gainers.
Is that you?
No, that would be Emily.
Oh.
Yeah. When Carol's out, I get to do whatever I want, Romaine, when Carol's not here. So.
Do you? Yeah, I know the feeling.
Took the gainers.
Yeah, absolutely. All right, well, we do have green across the screen here for the major U.S. indices, with the Dow Jones Industrial Average up more than 200 points, or about 0.6% as we get the closing bells here in New York. A low volume day to be sure, but the S&P 500 continues to power on for an 8th straight session, up more than 50 points, or about 1% on the day as it tries to creep back towards that record high, reclaiming 5,600 here on the day. That's the main headline across the Bloomberg terminal. The Nasdaq Composite up about 1.4% on the day. Similar moves on the Nasdaq 100, and the Russell 2000 trying to keep pace, up about 26 points on the day, or 1.2%.
Yeah, we're only about 1% off of those all-time highs for the S&P 500. As far as peeling back the layers of the S&P 500 today, 415 stocks did move higher. Only 84 stocks did move lower today.
It is pretty remarkable how broad-based this advance is. You look at the 11 sector groups in the S&P 500, and it's pretty much all green. In fact, if you break it down into 24 industry groups, the only reason you have that slice of red there is perhaps because the tech, hardware, and equipment group is mixed overall, and that's because of losses in HP. But otherwise, it is a sea of green.
All right, well, speaking of a sea of green, I got the gainers for you. I had the easy job today. I do want to start with shares of Advanced Micro Devices. AMD up by 4.5% today. They agreed to buy the server maker ZT Systems. It's a cash and stock transaction valued at just about $5 billion. The company, ZT Systems, that is going to be part of AMD's Data Center Solutions business group. And we don't often see shares of the company doing the acquiring actually move higher, but investors certainly applauded the deal, sending shares higher today by more than 4%. Also, keep an eye on shares of Palo Alto Networks. This is a company that is reporting earnings in the coming minutes. We're going to bring you those numbers as soon as we get them. Shares finishing the day higher by 2.8%. Shares have been on a tear just over the last 2 weeks. We got strong results from some cybersecurity peers, also that broader rebound in equity markets that we've been talking about. The big question is whether or not they've seen an uptick in sales post that CrowdStrike outage. So has CrowdStrike's loss been Palo Alto Networks' gain? Keep an eye on that in commentary as well. And finally, shares of McDonald's finishing in the green today. Evercore ISI analyst David Palmer raised his price target on the company from $300 to $320. Palmer is, quote, increasingly bullish on the business, which has recently seen relative market share trend improvements, Emily.
Can I just add another one to that? Fubo TV up another 18%
that was wild,
today.
Wasn't it?
Yeah, we're actually going to have the CEO on Fubo. This is just me just trying to do a shameless plug. Tim.
You can
Please
do that, but that was on Friday. Friday's news, right?
That's right. And now we have the CEO today on Monday, Tim, and I'm sure you'll be watching.
No, I'm not saying that the stock moved higher on Friday. I was out Friday, so if I...
It moved up Friday and it's moved up today.
And it moved up today.
Yep.
Okay, yeah. No, I think it's a great booking. Don't get me wrong.
Thank you.
Yeah, I might walk
Yeah.
off set here to go and watch the interview.
Thank you.
Well, first you have to listen to the decliners, Tim.
I will. I'm sorry. Please.
Way to call the shots, Emily.
As Scarlett mentioned, HP Inc., one of the only large cap stocks in the red today, falling about 3.5% as Morgan Stanley downgrades the computer hardware firm to equal weight from overweight, citing limited upside to estimates and valuation. Their previous positive stance was based on the view that the market wasn't appreciating a return to personal systems, revenue growth, stable print margins, and accelerating capital returns. This now all looks priced in, according to analyst Eric Woodring. He said overall the risk profile seems balanced for now. I'm also looking at shares of Shake Shack falling as much as 4.5%, along with peers Dutch Bros and Sweetgreen after Piper Sandler cut the stocks to neutral from overweight, tempering its view on the fast casual subsector. Analyst Brian Mullen says he's not negative on the burger chain Shake Shack, but sees the current risk reward as more balanced at current levels. You look at what the stock has done year to date, it's already up 40%. He set a price target, which now implies about a 6.2 increase from the last close for the rest of the year. And finally, I really had to go down the market cap spectrum to find another decliner. So I'm looking at Liquidia. The shares plunged as much as 41%, a record drop to their lowest level since December after the drug maker said the FDA delayed until 2025 the final approval of its Yutrepia inhalation powder to treat adults with pulmonary diseases. Needham called the delay a curveball scenario.
And I'll just add one more decliners too. Shortly in late in the cast session, we saw a big drop in shares of U.S. Steel. That was back on a report by Reuters here saying that former President Donald Trump, if he were reelected, would try to block that Nippon Steel deal. Let's take a look at the yield space. If you thought the equity action was maybe a little subdued in terms of volume, well, that nut doesn't even compare to what we saw in the Treasury space. We did see a flattening out of the curve, but you see the numbers on the screen. If you're in your car right now, nothing really to look at. We're basically talking about moves of about 1 basis point up or down here on the day, as a lot of people, of course, waiting to get a little more clarity out of the economic data this week and Jay Powell's speech on Friday.
Okay, well, before we get to Jay Powell's speech, we're going to get a bit of economic data. One piece of economic news that caught our eye today is the results of a survey from the New York Fed that talks about the share of people who actually think they're likely to be unemployed in the next 4 months. It actually reached a record high in that survey, which dates all the way back to 2014.
And at the same time, there's a rising number of consumers.
Hang on 1 second, Emily. We have some breaking news. This on Palo Alto Networks. The share has taken a big leg lower on a knee-jerk reaction, Scarlett, to earnings that have just crossed the wire for that fiscal fourth quarter.
Yeah, let's talk about what happened on the bottom line. $1.51 beats the consensus estimate by 10 cents. $2.2 billion in revenue, slightly higher than the consensus estimate. But when it comes to the outlook, Palo Alto Networks sees first quarter revenue of anywhere from $2.10 billion to $2.13 billion, a pretty narrow range. Analysts were looking for $2.11 billion, and first quarter adjusted EPS of $1.47 to $1.49. That is higher than the consensus estimate of $1.43. Overall full year revenue anywhere from $9.10 billion to $9.15 billion. Again, higher than the average analyst estimate, and full year EPS $6.18 to $6.31. Analysts were looking for $6.22. So a beat certainly on the quarter that ended, and it looks like a decent outlook as well when it comes to the consensus estimate and the stock rising in after hours trading now.
Yeah, we're going to get a fuller breakdown of these numbers in a few minutes with Dan Ives a little bit later, guys.
All right, so it looks like shares actually moving higher. There was that knee-jerk reaction, Romaine, that you mentioned, lower just after the numbers crossed, but shares up by 2.2% right now. The company's chairman and CEO saying that they finished off the year with strong execution on the platform strategy in the fourth quarter.
We're going back to our radio chat here. So going back to that survey of from the New York Fed, it was interesting taking a look at the labor market and exactly what it's saying here, because while there's a record share of people who think they're likely to be unemployed in the next 4 months, there's also a rising number of consumers who expect to receive a job offer in the next months compared with a year from now.
Yeah, it's pretty much a mixed bag, but you can definitely feel the turn from earlier this year. And there's a lot more anxiety, I think, around the whole labor market overall. So maybe it's time to kind of distract yourself with things like collectibles. McDonald's has these new adult Happy Meal cups. Have you guys heard about this?
Adult Happy Meals?
Happy
Is this
Meals
with
were
like
for
liquor
kids.
or something?
No, they've turned into like a collectible gold mine for these cartoon-themed cups. They've showed up on eBay, and they fetch prices as high as $100.
So these are cups really for kids, but adults are stealing them from the kids.
Pretty much.
Is that what's going on?
Yeah.
Is there an economic indicator here? I'm getting sort of like 2021 FOMO, sort of like,
Yeah. Well, I'm all for this. I remember when I was a kid, and you said, you get the little, Star Wars collectible plates and all the little big movies and stuff. I miss those days.
Yeah. Okay. Well, then go.
Life is simple then.
It was. You can go get Barbie,
sorry.
Hot Wheels, Beanie Babies, Coca-Cola, Shrek, Jurassic Park, and Minions, or Grimace.
Oh, Grimace.
Yeah.
I wouldn't want to
Grimace.
Grimace.
He's
When
back.
I lived in Hong Kong, they had these Hello Kitty special edition dolls.
Remember when Grimace Core was a thing?
What?
Grimace Core.
No.
Oh, gosh, no.
Grimace Core?
Yes.
I missed that one.
It was a fashion trend that swept the nation.
You
All
just
right, so
dress
tomorrow,
in purple, looking like
please
Barney?
dress in Grimace Core.
I don't get
Romaine.
it.
That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We're going to all be back tomorrow, same time, same place.
And we continue our markets coverage right here on the close. And now with the bells having passed here, we are starting to see some earnings cross the wire, including out of Palo Alto Networks. Dan Ives, the senior equity analyst over at Wedbush, going to be joining the big program to help break down the results. This is the close on Bloomberg.
Welcome back to the close. I'm Scarlett Fu.
And I'm Romaine Bostic. The rally, of course, that took shape, if you will, more than a week and a half ago, continues on here on this Monday afternoon. And S&P 500 adding just about 1% here to its tally, back above that 5,600 level as it tries to creep back up towards that record high. We saw similar moves for the NASDAQ, the Russell, as well as the Dow here on this Monday afternoon, despite the weakness that we saw in the dollar and some of the weakness that we saw in the Treasury space. Keep an eye on crude oil as well. This is one of the first breaks that we've had below 75 in quite some time, down about 3%. Still a lot of fears out there about the demand picture, particularly, Scarlett, coming out of China.
Yeah, absolutely. But we are looking at a couple of notable movers here. Let's start in the big tech space with AMD, the chip maker, up 4.5%. A one-month high, actually, today, after the company agreed to buy server maker ZT Systems for $4.9 billion in cash and stock. This move adds data center technology to AMD's arsenal, allowing it to better compete against the industry leader, NVIDIA. Also, Zim Integrated Shipping Services, it's a shipping company, raising its full-year EBITDA guidance, saying that the second half of the year will be stronger, much better, in fact, than the first half of the year, thanks to supply pressures from the ongoing Red Sea crisis, as well as what it says favorable demand trends. So that stock, after soaring as much as 25%, closing up about 17%. And Fubo, gaining for a second day, actually gaining for a fifth day, to be honest, but it really extended Friday's surge by gaining another 18% today. And this after a judge delivered a legal victory to Fubo, blocking Venue, which is that three-way joint venture between Disney, Warner Brothers Discovery, and Fox. They were planning to launch that sports streaming service. Well, it's not going forward for now. So a legal victory for Fubo. And by the way, stick with us because Fubo CEO and co-founder David Gandler will be joining us later this hour to talk more about what is next for his company.
All right, let's get back to that breaking news on Palo Alto Networks. The earnings just crossing the wire here. Revenue of about $2.2 billion, up about 12% on a year-over-year basis. EPS $1.51. Both numbers coming just ahead of Wall Street estimates. Dan Ives, senior equity analyst over at Wedbush, joins us right now to talk a little bit more about this company. I mean, look, this was a stock that was on a tear really the last couple of weeks. I mean, it had risen about 16, 17%. And a lot of people wanted to know whether we were going to see that justified by the results that we got today. Were they?
I mean, for the bulls, it's a dream quarter.
Yeah.
Because they delivered not just in terms of the quarter, but the outlook. You look at what we see in cybersecurity in terms of Fortinet, Checkpoint, now Palo bodes well for Zscaler. We obviously had the CrowdStrike black eye, but this is a golden age for cybersecurity being led by Palo Alto.
Being led by Palo Alto. So if I'm looking at this as an investor, you think this is the market leader in terms of pure play cybersecurity companies?
Table pounder. It's just the start in terms of where we see this going. Platformization. Nikesh, one of the best CEOs out there. That's why, look, this is a quarter. They should print this out, put it in the Louvre. It's another sort of masterpiece in terms of where I see the Palo Alto story going.
Well, yeah. Is there anything in here that looked somewhat concerning to you? Because there's a lot of players in this space. And we've been talking about consolidation in the cybersecurity sector. And certainly Palo Alto Networks is a buyer right now. But is there anything in here that maybe gives you pause?
I think to some extent, there was some nervousness going in, despite the stock, just nervousness in terms of the overall space. You look at what Nikesh is seeing, especially even off quarter. This for bulls in tech, for bulls in cybersecurity, this is exactly what we want to see. But I do believe consolidation, this is just a drum roll. Get out the popcorn. We're going to have a lot of M&A in cybersecurity. You thought about that Google Wiz deal, which ultimately didn't happen. But this is a start. There'll be an acquirer, but there's going to be many acquirees in terms of where I see in the sector.
What about a company like Microsoft buying more of its own cybersecurity capabilities? Because right now, these are kind of add-on services when you already subscribe to Microsoft's software, right?
Well, especially when look what's happened in the cloud. I think Microsoft, Amazon, Google, they will aggressively potentially look at cybersecurity. And also when you think about the overall FTC con, wherever that heads from an antitrust perspective, potentially more M&A in big tech, stronger and going to get stronger. And if you look at what's happened in cybersecurity, this is really one of the best barometers in terms of what we see in overall IT spend. We'll have Salesforce and some others, but if you're a bull from from an overall tech perspective, this is exactly what you wanted to hear in terms of barometer.
I am curious in terms of the IT spend. I've heard people basically say that a lot of corporations, they don't actually want necessarily a bundled cybersecurity product, meaning, if you fold that in with the Microsoft, to them that makes it less attractive. They want some separation. Are you finding that to be true?
No doubt. I mean, pure play is of one. That's why if you go into a typical server room, you'll see 25 cybersecurity software pieces in there. But look, Palo Alto, what they're essentially doing is platformization. They're trying to benefit more and more. They're just continuing to expand in terms of what they're seeing.
Well, that's what I'm curious about, the strategy that the CEO is taking here. Because when I hear that platform, I think, is that kind of sort of like add-on products and services? I mean, what does that look like? What are they trying to turn themselves into?
It's really about the shift to the cloud. Because
to the cloud,
take a step back. More and more data moving to the cloud, AI revolution, that has to be protected. Cybersecurity is going to be a second, third derivative of the AI revolution. So Palo Alto, they continue to play chess while others play checkers, and I think what they're doing is really skating to where this is all going. And look, for this quarter, remember, you go back, they had 2 quarters ago, they had a pretty soft quarter. This is a huge validation.
I was always good at chess, but I sucked at checkers, and I
really?
never forget. I think it's because I overanalyze everything, which works well in chess. But with checkers, I mean,
it's we should play checkers one day and see.
I want to see you guys play Chinese checkers.
Who knows?
Let's just broaden this out to overall technology, because earnings season is pretty much over. I know we have these cybersecurity companies, a lot of enterprise software companies, but it feels like we're kind of in a quiet period waiting for NVIDIA next week. Have people made adjustments to their NVIDIA numbers based on what we saw from, say, the Microsoft, say, the Alphabets, and everyone else who, didn't quite live up to expectations with the AI spending?
Yeah, you've seen it, but even when in Microsoft, they guide strong on the Azure growth in terms of second half, you've seen numbers tick up for NVIDIA. But look, it all comes down to hearing from the godfather of AI, Jensen, NVIDIA. I think it's going to be a drop the mic moment. I think another sort of validation for where we see AI spend. And from a tech perspective, you put all these pieces together. Unless you have binoculars or a telescope, hard to find the recession here, especially when it comes to big tech.
Yeah, I mean, it kind of sets the tone for the rest of the tech sector. When you talk to your clients, what's the company they ask you most about?
Probably the Messi of AI, Palantir, because that's been one, from an AI perspective, I think many viewed it in the background, now really front and center in terms of use cases, what we're seeing, I think not just in terms of the quarter, but now we're seeing what's the second derivative in software. Is it ServiceNow, Microsoft, Oracle? And Palantir, I think, probably one of the best purest play AI names out there.
It's interesting to look at the companies you cover. By the way, you have a very eclectic mix of companies that you cover. I'm not sure how you're able to convince your bosses of that, but you do a great job. But one thing that I notice is you seem to be covering a lot of companies that are really kind of on this inflection point in various technologies, whether it's AI or autonomous driving and EVs and things like that here. When you look at where we are, and I'm talking about from an investor perspective, and where you want to be, and where we think what the world is going to look like, and more importantly, what the stock market's going to look like, and who's going to dominate it here. Do you think we should be looking at the established companies like the NVIDIAs and Microsofts, et cetera, or is there going to be a new crop of companies that comes in and maybe eats their lunch sometime soon?
Well, I think the strong get stronger in terms of big tech, but there are going to be companies that will become household names because you start to think about this is the biggest tech trend, biggest transformation we've seen since the start of the internet, 1995. And when you look at $1 trillion of incremental capex, that's where there's names like Palantir. There's some other software names out there that will be the next sort of generation. But when it comes to NVIDIA, Microsoft, big tech, strong get stronger in the AI revolution.
What's the company that gives you most pause right now when you look at big tech?
Look, I think most pause is probably Intel, because that's one, if you looked up disaster in the dictionary, you'd see Intel's ticker. And that's one, despite you call it a value trap, it just shows have and have nots. You got the godfather of AI, Jensen, with his black leather jacket. Then you have Intel, which is just dog ate the homework.
Yeah, they're struggling to find their way right now, certainly.
Struggling would be a compliment.
Dan Ives, senior equity analyst at Wedbush, never one to be shy about how he views those companies. Coming up, we've got a lot more to cover, including the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg.
This week, Balance of Power is live in Chicago for the Democratic National Convention.
So we've got a race here, and the sprint begins.
We'll bring you breaking developments.
Vice President Kamala Harris closing the gap with Donald Trump.
And informative analysis, all leading up to special coverage Thursday evening, including Vice President Harris's acceptance speech as the Democratic nominee for president.
As president, I will show Donald Trump what real leadership looks like.
Tune in all week on Bloomberg Television.
It is time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Carl Icahn. The billionaire and his investment firm agreed to pay $2 million to settle an SEC probe into margin loans. And of course, as part of the settlement, he neither admits nor denies any kind of wrongdoing or, confirming the SEC's findings. But the issue here was that Icahn didn't properly disclose how much he was borrowing against his stake in the company.
Yeah, I mean, this was, of course, was a lot of speculation around exactly what was going on there. Now, I guess we get a resolution here, though. $2 million? I mean, like Carl Icahn, he's got to be laughing at that, right? I mean,
he pledged up to 65% of his company units from 2018 to 2022 in return for up to $5.1 billion in personal margin loans.
All right, well, $2 million to make this go away here. Carl Icahn continues on as the legend that he is. A person that I've been keeping an eye on is Mike Lynch. Of course, he was probably best known as the co-founder and CEO of Autonomy. Unfortunately, a very bad situation took place kind of off the coast of Palermo, Italy. A luxury yacht sank. At least 11 people were able to get off board, but we're learning at least 6 people have died. Several others are missing. That includes Mike Lynch himself. His whereabouts still yet unknown. Of course, he's been in the news as of late for a recent trial that he had here in the U.S. Related to the sale of his company to HP a few years back.
He was found not guilty over accusations that he committed the biggest ever fraud in Silicon Valley. I believe his wife was rescued, but and they were celebrating apparently that.
Yeah, his acquittal. Yeah, it was quite an awful story here, and there's been a lot of talk about these sort of tornadoes that I guess are common in this area, and they create these water spouts, and at least one of the survivors has given a very harrowing story about trying to save her baby and some of the other folks here. So, of course, we wish him the best, a controversial figure, but nevertheless an absolutely sad story.
All right, and the third person we're watching today is J.B. Pritzker. He's the Illinois governor. He's in the spotlight with Chicago hosting the DNC, and of course, securing the DNC was a culmination of years of groundwork led by J.B. J.B. Pritzker.
Yeah, I mean, this is his time to shine. Of course, the Illinois governor, and of course, really that whole family has been very instrumental to the city of Chicago. So I guess time for him to shine. And you have to assume at some point, I mean, I don't want to speculate too much, but he's clearly,
going to run?
He has other ambitions beyond just being governor and being a sort of a funder of the current political candidates.
Yeah, well, he can fund his own candidacy, certainly.
Yeah, he certainly can. Whether the people want him to, that will be another thing to consider here. All right, we do want to get to some breaking news that we had just a little while ago, Scarlett. This involving Andersen Global, the tax and legal services company, is reportedly weighing an IPO of its U.S. business next year. This is according to a report by the Wall Street Journal. The Journal also saying, Scarlett, that they are considering private equity investments as well. Of course, this firm, as it known today as Andersen Global, goes back, of course, traces its roots back to Arthur Andersen, which has a very colorful past.
Yeah, it ceased to exist after the whole Enron thing.
Yeah,
so
exactly.
how much of this is Arthur Andersen?
Yeah, I don't know. I'd have to go back and look at the structure of it, but this is the legacy company of that here. We should just be very careful about that. But of course, they do have ties back to that. I just think it's interesting here that this could be a return to the public market of a name that, of course, for a lot of people has a lot of good things associated with it and, well, a lot of bad things associated with it.
Everyone in business loves a comeback story. So this would be the mother of all comebacks if this does come back as a publicly traded company
and you know what,
sold off.
And you know what they love more than a comeback story? The comeback of a tax and legal services firm.
Yeah, that would do it, yes. Checking the box. Coming up, we've got more on the election and what it means for markets with Michael Zezas. He is head of U.S. public policy research at Morgan Stanley. We've got the DNC really kicking off in earnest tonight. I mean, there's stuff going on during the day right now, but President Biden's speech tonight really kicks things off, doesn't it?
Absolutely, yeah. We'll all be eyes on that. Stick with us, all eyes, coming up right here on The Close on Bloomberg. All right, the national convention for the Democratic Party here in the U.S. is underway in Chicago, with the current president, Joe Biden, set to take the stage tonight. And what most people anticipate is going to be kind of that formal passing of the baton to Vice President Kamala Harris in her run for the presidency. Investors are bracing for impact as the election cycle continues to unfold. On average, market volatility is higher during presidential election years, especially up to and through that actual election date. Michael Zezas joining us right now, head of U.S. public policy research over at Morgan Stanley. Now, it kind of makes sense that the volatility would pick up as everyone tries to game out who's going to win and, more importantly, how it's going to affect potentially policy that could affect the markets here. Is this election, is there more uncertainty around 2024 than maybe what we saw over the past few election cycles?
I don't think so. And I think it's one study that we did showed that historically, actually, there's not a lot of pattern to how markets behave into elections. So you pointed out that there's more volatility, and that makes sense. But what we know is that if there isn't any historical pattern, which there really isn't, and then it's highly uncertain as to what the outcome is. And if you look at prediction markets, it shows about a 50-50 toss-up. That's more or less what the polls are showing. There's not much for an investor to do ahead of time to make proactive choices with their portfolio. I think most of it hinges on what happens in understanding the policy choices and their knock-on economic impacts after the fact.
It's interesting, this election, because to a certain extent, we're kind of dealing with two relatively known quantities. Obviously, Trump was president for 4 years, so we kind of know his platform. And Kamala Harris, I mean, you can quibble as to whether she's articulated her policies, but we've already seen what the Biden administration has done here. So why are people kind of on edge? Like, what is it that we don't know about these two that people are worried about?
Well, I think there's some key differences this time, particularly as it pertains to the outcome if Republicans win.
Okay.
Right? So in 2017, what we knew going into a Republican sweep scenario is that the first focus was really going to be on tax cuts and fiscal policy, as well as the Affordable Care Act. This time around, that's also true, except the sequencing is different. So Republicans do want to extend most, if not all, of the Tax Cuts and Jobs Act's expiring provisions, which would create a pretty big deficit impact in 2026. But the catalyst for that's at the end of 2025. The sequencing is important because the first thing Republicans might do this time have to do with raising tariffs and curbs to immigration. Those could have some near-term impacts for the economy in the way that the fiscal impact would have that might offset some of that. That would have to wait until 2026. So that's a big difference. You see markets trying to, when Trump's odds were higher immediately following the last debate, you saw markets trying to sort that out with steeper yield curves and small caps doing better within the equity market. Now that things are back to kind of 50-50, there's not really that being teased out in markets. But that is a key difference that we'll have to contend with if Republicans do well in November.
Well, when you look at these two campaigns, in a lot of ways, they have policy that's similar in that they're both anti-China, right? They're both cracking down on M&A, and it doesn't appear that they would necessarily let there be a lot of transactions without a lot of scrutiny, right?
I think that's right. And so the principles are very similar, but the tactics are quite a bit different. So take China, for example. You're right, the principles are to take the U.S. in more of a, I don't know if protectionist is the right word, but more of an approach about protecting its own interests. But the difference is that Democrats have leaned heavily on non-tariff barriers and basically letting things like export controls kind of take a more surgical and transparent approach to creating that separation with China. Republicans also embrace those non-tariff barriers, but of course, President Trump really interested in using tariffs even more heavily. And that's where there's a lot of potential short-term noise as it pertains to growth and inflation.
Got it. What's the usual timeline of when people really start positioning for the election outcome? I know we're in mid-August right now, but is this something that doesn't really start to appear in earnest until like October, or when does it start picking up?
Yeah, well, so what the data would tell you is that there really isn't a precise time for when that positioning takes up. In elections that are not perceived as close, right, so where polls show that it's highly likely one candidate's going to win versus the other, you could start to see impacts that reflect those policy choices as you get closer to the election, maybe something like October, for example. But really the market impacts pick up after the election outcome is known or sort of largely known. So in 2020, you had that period of uncertainty when you're still counting vote by mail ballots. By the way, that could happen again this year because things are so close and vote by mail is so popular. I wouldn't expect there to be really heavy market positioning for one policy set or the other until we feel like that election week is behind us.
It's funny, too. I mean, we talk a lot about these policy proposals, but a lot of these proposals that we're talking about aren't going to see the light of day unless they get through Congress.
That's right, yeah.
And we haven't focused as much on that. Everybody sort of wants to look at the horse race between Harris and Trump here. But do we have any sense of what the makeup of Congress is going to look like come January?
Well, I think you're right that we need to kind of filter the party platforms about what's plausible and what could get put through Congress. I don't think there's really any kind of heavy favorite in terms of the congressional outcome. But it's important to understand this filter because, for example, even in a Republican sweep scenario, Republicans could say, we want to extend all of the Tax Cuts and Jobs Act expiring provisions. That's a $4 to $5 trillion ticket. We think if you use as a filter instead what kind of the median Republican could do, that's going to be a ticket that's closer to $1.5, $2 trillion.
Are you finding in your research that voters, and I'm talking about regular people, not just investors, but voters are genuinely concerned about the debt and deficit issues? I know we talk a lot about it in this program, but I feel like for a lot of people it's kind of out of sight, out of mind.
It's difficult to ascertain even when you just open up polls because voters won't express it as a debt or a deficit concern. They're concerned about inflation, which obviously has interaction with debt and deficit. They're concerned about the economy, which has interaction with debt and deficit. But deficits themselves don't seem to be intrinsically pushing voters one way or another.
All right, good stuff. Really appreciate your joining us today. Michael Zezas is head of U.S. Public Policy Research at Morgan Stanley, answering all our questions about the election. Let's take a look at how markets closed on the day. At session highs, and it was a lift in the very final minutes of trading as well that pushed the S&P 500 above 5,600. And look at that, the Russell 2000 outperforming as well. So that rotation into small caps still at this point intact. Yeah, a lot of people still bidding for those kind of second tier companies, of course, as we are in the middle of, I guess, the second tier or maybe third tier of earnings season now here. You see the VIX tamped down here back below that 15 level and a 10-year right around 387. This is the close on Bloomberg. A slew of noteworthy retailers report earnings this week, including Macy's, which owns Bloomingdale's, Target, and TJX. Now, new research from Bain Company suggests that shoppers are no longer finding value in department stores. Monisha De La Rocha is a partner at Bain Company, and she joins us now to discuss. And the department stores are struggling to really find a good audience in younger shoppers, particularly Gen Z. It feels like the older demographic Gen X, maybe baby boomers, are much more loyal to department stores. How do you see them responding to this shift?
Well, thank you for having me. At Bain, we've been following and supporting the department store sector for many years. And of course, there have been questions about the outlook for the department store, their relevancy, particularly as the consumer demographic is shifting. We do see in our research that the younger consumer, in particular Gen Z, does not have department stores in their consideration set. As we think about what the retailers can do about that, for us, it has really come down to delivering against the changing needs of that generation around exciting experiences, assortment that is always fresh, and a real value for that consumer.
Have you seen any of them execute on that? Are there any examples where they've succeeded on that front?
I think we see examples in particular around the evolution of what that assortment should be. You know, if we look at retailers like Macy's, they are being able to capture the spend in a category like beauty, which is very important to that consumer segment, through their expansion of the retailer Bluemercury. What we have seen to be the challenge is that these types of innovations have not yet been able to create full bottom line impact. That is to say, they haven't been able to scale to a level that the overall company's performance can really reflect those types of investments.
Yeah, I've been always curious about that, because as much as we talk about sort of these new sort of online disruptors, we kind of overlook the fact that most of them actually aren't doing any better financially than some of the legacy names here. I am curious as to whether you think we could either see the pendulum swing back in favor of the department stores, or more importantly, if maybe we see more of an amalgamation, a mashup between that legacy department store model and some of the newer online tactics that we've seen from these startups.
It's a really important point. As we think about who is winning when the department stores have been struggling, we see two areas that we have really seen success from a consumer standpoint. One is the online retailers that you're describing. The other is a continued growth in the brands that are opening up their own stores. They're investing behind their own websites. But it does pose a challenge. We have seen absolutely a challenge on profitability for the online-only retailers. And we do see for brands as well, as they are looking to invest in their stores, invest in their e-commerce, that they are realizing the complexity and the cost that comes along with that. So those give us real optimism that the department store continues to play a role. They are very important to their brands, to their vendors. And we do expect to see and hope to see some real innovation where brands and their retailers and the department stores can think about new ways to partner and new ways to create value for the consumer.
Why haven't we seen more of that? I know there's been some experimentation, particularly with the Bloomingdale's brand, experimenting with those types of partner relationships. And I also know that to a certain extent, Nordstrom attempted to try some of that as well here. Why isn't that more widespread?
At Bain, we see two challenges with the innovation. I absolutely think if we were to sit down with a set of executives, they would say this is not a lack of trying. Their lists are long. They have tried many things. The two challenges we've seen, the first of which is often the innovation is siloed in the function. There may be an innovation to try to reimagine the store experience or bring a new vendor online and try to kind of add a new brand. But the innovations haven't been cross-functional enough to say, what do we really need to deliver to the consumer? What is that young consumer looking for? And how does that impact assortment, the store experience, marketing, the supply chain? So I think one challenge is that the innovation hasn't been broad enough. The other, I think, is around that investment behind the right innovations to scale. And so often some of these innovations can take form of a pop-up, and it can be in a small set of the stores. Instead, what we would say is we have to create focus. Retailers need to think about where they should invest and then really put the money behind that to be able to scale to get the impact.
Great stuff. Monisha De La Rocha, partner at Bain Company, on the retail experience right now and the retailers that will be reporting earnings this week. Now, another company that we're watching is Fubo. Shares of the streaming service closing the day up almost 18%, extending gains after a judge blocked Fox, Warner Brothers Discovery, and Disney from launching their streaming sports service called Venue. David Gandler is co-founder and CEO of Fubo, and he joins us now. David, great to see you here. Now, there was one analyst, Laura Martin of Needham, who says that the injunction has a 75% chance of killing off Venue. What do you think?
Well, I think, from my perspective, one, the most important thing is that the consumer is the big winner today. The joint venture attempted to deprive consumers of choice and affordability. It attempted to eliminate competition and manipulate pricing. And I think the evidence was quite clear, given that the bar is so high, and we're just happy the judge has agreed with us.
So it's likely that Venue will make its case again before the court. What are you going to be doing before then? Because it's not clear how long this injunction will last.
Well, we don't have a date yet set for the trial, which could be in 2025 or 2026. Fubo today is focused on the fall sports calendar. We're not focused on any potential appeal. Pun intended. Ball is in their court. So we'll continue to focus on our business and continue to achieve profitability as we have forecasted in 2025.
I am curious, David, too, about the structure of that Vino deal. There was some discussion, I guess, based on the reporting coming out of the hearings that led up to the ruling. This idea that they were asking, I don't know if it was specifically you, but they were asking some of the rivals that they would, in addition, if they wanted the sports programming, they also had to take additional programming as well. Is that true?
Yeah, that's correct. I think one of the arguments that we were attempting to make is that not only were there excessive above market rates that we were dealing with, excessive penetration rates, which is the number of subscribers that gain access or have access to each of the networks, which obviously comes at a higher cost, but it's also the bundling of unwanted channels to access must-have sports programming. Those are the sort of key elements of the trial. And again, we believe that we're able to provide the judge with sufficient and credible evidence for her to judge in our favor.
I'm just going to play devil's advocate for a second, David, because when we look at sort of the legacy cable TV bundles, there was sort of baked into that almost a certain degree of exclusivity, a certain degree of you come to us or you don't get it at all. And obviously they're trying to extend that to a certain extent to the streaming side. Right. But if that was okay then, and I'm just talking legally okay, I know consumers hated it, but if that was okay then, why is this not okay now, if it's simply because it's online?
Well, it's not that simple, and it's not because it's online. The problem is that we have attempted to put together a skinny bundle of channels to offer to consumers since 2015. And at every turn, we have been denied the opportunity to do that. And in this last negotiation with Warner Brothers Discovery, we asked for the same terms as this joint venture was able to receive. And obviously, we don't have a deal with Turner TBS, nor do we have a deal with Warner Brothers Discovery. So really, this is about keeping it for themselves and not creating enough access across the ecosystem.
Just to be clear, David, why didn't they take, I mean, if you said you offered the terms that they were asking for, do you have any sense that they articulate why they didn't take it?
Well, again, I think you said it very well. I mean, they sell the complete bundle. They want to package in channels that are difficult for them to sell individually or separate from sports programming. And I believe that there's been sufficient evidence, and perhaps some of that information has been unsealed, that they feel that they have significant leverage over a distributor when they're able to package together the sports programming.
So give us a sense of what you're thinking in terms of what Fubo does next, its next iteration. Is there a future in which Fubo only offers perhaps a sports-only package as well?
Yeah, well, I think the key word is as well. I think the idea for us is we're continuing to focus on our super aggregation strategy. We want to be able to attract customers at different price points across the demand curve, everything from free services all the way up. I'll call it the fat bundle, as we called it throughout the trial, which is a more expensive, $80, $85 plus package. But there's a whole set of content packages that we feel that we can offer from zero to the fat bundle that we think consumers will really take advantage of. And they may take advantage of it at different times throughout the year, given what premium programming is available on a seasonal basis. So there's a huge opportunity here, and we're not in the App Store business, we're in the super aggregation business.
Have you had any talks, David, about adding, say, Disney Plus or Max to your streaming offering, to those fatter bundles or fat bundles, or is that pretty much a non-starter right now?
Well, we've obviously have asked in the past. I'm sure other distributors have probably asked for that as well. At this point in time, I think that they were not ready to do that, and our backs were against the wall. And, in a situation where we feel that the U.S. consumer will suffer from a lack of competition and affordability, because over time, I'm sure you've seen this, prices continue to move higher. Frankly, the Disney Plus product, I think, has doubled in price over the last 4 years. So there's a clear example and many examples of prices going higher when there's just not enough distribution.
All right, David. Well, we really appreciate you taking time to be on with us to talk about this. David Gandler there is the co-founder and the CEO over at Fubo. I am curious to see, Scarlett, how this case winds out here. I mean, you can obviously, I think, from a consumer perspective, understand why this is important, but I don't know enough about the law to know enough whether he's going to be able to win.
Yeah, and I'm sure there's a lot of frustration on consumers' parts because of that, because it's in a state of flux. I just think about how much I spend on all my sports needs and all my cable needs, and I
needs.
Yes,
these are consumer staples in your house.
They are,
okay.
Unfortunately. The bill, like David said, is getting heftier and heftier with, increases, regular increases, it feels like every other month.
Yeah, I feel you here. I mean, I feel like we're just going back to the future, if you will, with these new
Bring on the cable bundle.
All right, when we come back, we're going to set you up for some of the potential market-moving events over the next 24 hours. This is Bloomberg.
This week, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for continuing coverage leading up to a special episode of Surveillance August 23rd at 9 a.m.
All right, it's been a busy day on Wall Street. Tomorrow could be even busier. Let's set you up with some of the potential market-moving events over the next 24 hours, and that includes a few earnings starting before the market tomorrow.
Yeah, Lowe's is going to be reporting, and we already heard from the bigger competitor, Home Depot, about how consumers are in this deferral mindset, right? They're deferring spending on things that they don't absolutely need. So I'm guessing that's going to be echoed here.
Yeah, I wonder too. I mean, it was interesting. People try to draw this distinction that Home Depot and Lowe's kind of cater to a slightly different customer. Home Depot is supposedly all contractors, and Lowe's is just basically, people like me who just want to get a potted plant or something like that. So I don't know if that's going to factor into it as well. But I mean, look, you don't have to build a new deck. You can just, brighten up your house with, something small.
Yeah, but you can also do that on the Facebook free groups, too.
It's a simple pleasures, Scarlett Fu, there. Well, speaking of which here, I guess if you don't have a home to actually fix up, maybe you want to get one. Toll Brothers scheduled to report after the bell tomorrow.
Yeah, this is the luxury home builder. So if you believe that we have a K-shaped economy, then technically, Toll Brothers would be in a better position than perhaps a home builder that caters to first-time buyers.
Yeah, and this gets also to this thing. I was taking a look here because we talk about how long-term these home builders look, which they obviously have to. So they don't really get too caught up in all the, masternation over interest rates on a day-to-day basis.
No, but they do buy downs on the rates.
Yeah, so they're looking forward here, and they're saying, look, if you see long-term structural trends, meaning housing shortages, and you got to build somewhere here, who benefits from that? I guess if they play it right, other than Toll Brothers.
Absolutely.
All right, what else we get? Fed speak. I know you're big on that. Raphael Bostic and Michael Barr are both scheduled to speak tomorrow.
Yeah, and of course, this is kind of just a drum roll to Jay Powell speaking on Friday at Jackson Hole. What are they going to tell us that, Jay Powell's not going to tell us? I don't know. But we'll go through it anyway. We'll go through the motions, and maybe something interesting will come out of it.
And we will bring you full and complete coverage of those comments when they happen. We're also going to bring you full coverage of the Democratic National Convention, which kicks off tonight with some major speeches, including from the current president of the United States.
Yeah, and our reporting shows that he's going to really sell Kamala Harris as opposed to talk about his legacy.
Yeah, which I guess is kind of what he has to do. This is a step aside. We're expected to hear from the mayor of Chicago as well as Hillary Clinton. We'll be back tomorrow. Please join us right here on The Close, right here on Bloomberg.